All right, welcome back to More Options Fun. If you don't know who I am Ben Collins, the founder and chief investment officer of Options Autopilot, and today I'm going to cover the 111 strategy. I think this has gained in popularity quite a bit in the past year, mostly that I'm aware of from Tom King and some other traders, and it's obviously just a ratio spread, but people came up with names from the 111, the 112. If you think that this is a good kind of walkthrough, I also have a video on the 112 and a systematic put credit spread strategy, the way that I approach it. And I'm going to basically go over this trade in general, how I would put it on, how I think about it, some of the risks that I think you need to be aware of that a lot of people don't cover, in my opinion, or they don't cover it well enough. That's why a lot of people got stung in the Volmageddon spike, and likely, more recently in the spike just a week or two ago, a week ago. So I want to go over that, cover that, and basically how I would manually trade it and how I've manually traded it before. But then also at the end, we're going to go over how to automate this with Options Autopilot and how much easier it is, in my opinion. But I do want people to understand, the risk management, and if they are going to manually trade this, how they can still do it if they choose to do so. So let's just dive in. Obviously, I've got Thinkorswim up here. You cannot automate at the moment of this recording futures options through Autopilot, but they are working on that with us to make that possible. So stay tuned. Hopefully by the time anyone else is seeing this, it is live and you can use Schwab to trade options on futures with Options Autopilot. But in general, right now we'll just use it because I like the risk graph and everything better. You can do this on Tasty Trade, and that's how I've traded it generally. But right now I just like how the visuals are a little bit better on Thinkorswim, so that's why we're going to use this system. So as you can see, this is the risk graph for a 111, and if you're not familiar with it at all, I would suggest going to optionsautopilot.com. We do have a course on all of these things and all these concepts. We also have a downloadable PDF that you can get that kind of walks through this plan as well. So get that down below, and it'll cover some things. So I'm not going to dive into the fundamentals of options, theta. If you're looking to trade the 111. I want people to be aware of this, but I'm not going to go fully in depth as to what options are. I think you can learn that from other resources. And ultimately, I guess if you didn't want to learn it, you can just automate it still through Options Autopilot, but I don't recommend that. I want people to know, why they're profiting, how they're profiting, and, what's kind of driving those profits. So the market's closed right now, so that might impact some of these prices and graphs, but in general, this is the risk graph of a 111, and what the 111 is basically a long put debit spread and then a naked put on top of that. And that's where they come up with the long one, short one, and then short another one. So technically it's a 1/2 ratio spread, but it's not all the same strikes. So what this kind of creates, and people like to call this the bear trap trade, because you can basically profit to the upside. Obviously, you can earn a credit. You can see here at expiration, it would be $760 of potential profit, and the margin requirement initially is $47.79. But if the market starts to move against you and it doesn't move against you too quickly, you have the potential of earning a multiple on your credit. As you can see here, if the put credit spread, the price of the underlying, which is the S&P 500 futures right now, if it finishes between the put debit spread strikes, obviously you can then earn a $5,760 potentially. It's possible you would get stopped out before that happens, but this is kind of one of the better trades, I think, for 2025 or just in general. It's kind of an easier way. It's not like you're just selling a put spread and you have no kind of directional hedge at all. The long put debit spread is helpful, in my opinion, and gives you the potential to, if the market does finish in this area, anywhere in here, you potentially can earn a lot more money. The interesting thing, and I've gone over this in one of my back testing videos, so I'd recommend checking that out, is a lot of places can't show this type of logic. So even if you put on the 111 and you put on a profit target, basically, it will only take the profit at the profit target. It's not smart enough to know, when is it in this bear trap. With options autopilot, it is smart enough. So it will basically keep your stop loss on in place. So you're still protected there, but it'll turn off your take profit. So you basically, or you can actually adjust a higher take profit for this bear trap area. So it doesn't have to fully get 100%, but it gives you the ability then to earn the multiple here. So I know I've heard Tom King talk about how, his 112s or even his 111s did very well in 2022 when a lot of people lost money. And that's because the market was kind of consistently drifting down. I wish obviously I was trading the 111s. I was trading, put spreads or even naked puts. And mostly kind of cash secured puts at that time. But the 111, apparently he's claiming, I've never verified this, that he made 80% in 2022 because he kept earning multiple on his credits instead of just the basic kind of credit. But the nice thing, compared to even an iron condor or whatever, there's no directional upside risk. It's just downside risk, right? So we need to be very good about our stop loss and managing the risk, because you can see you can get out of hand quickly if the market falls, right? This is a slice of the market being down 10%. And this is, again, the instantaneous profit and loss graph. So this purple line is what it is today. Over time, it will move up, as the options are decaying into this blue line. If people are not familiar with this, but you can see that you can obviously take a significant loss, and that's why you want to have your stop losses in place, and you want to be putting these on consistently, because if you take a loss, the best thing to do is probably actually just put another one on. That's how you end up making money in the long term. In general, markets go up and volatility is mean reverting. So consistency is key, and that's why I think automation is very helpful for most people, because even I am impacted by psychology, and you kind of freak out if the market's falling. In the recent volatility spike, I actually put on a trade, even though it didn't feel very comfortable. It ended up working out fine. I closed it out too early, kind of proving the point that I shouldn't interfere and I should just let the automation just totally manage it. But that basically was a very quick trade, and ultimately volatility came back down and made a profit. I think I hit a 40% profit in like 3 days, right? So that's partly why I took it off early, just kind of capital efficiency there. But in general, I would have been even better just leaving it on an extra few days. So that's kind of besides the point. What I did want to cover, though, that I don't think a lot of people cover enough, they'll always say, oh yeah, it's very delta neutral, very non-directional. Obviously, you can see it starts to get a little bit sketchy if the market starts to fall about 5% pretty quickly. So that's how you can get stopped out. The other thing I would point out, and what I think is helpful on Thinkorswim here, it's showing you, your theta. Theoretically, if the market just sat around, you'd be making $26 a day, and volatility was not changing. But the key here is you are short volatility, being your short Vega, one of the Greeks. And not enough people cover the fact that this can move very quickly. If we go to what happened even just a week ago, let me pull this up. This is ES. If we look at the VIX, this is the past year daily chart. This was Volmageddon. This was a massive spike, and a lot of people got damaged doing this. I avoided some significant loss. I think I only had a 10% drop. I know Tom King himself wasn't too forthcoming with his losses, but he basically took a 50% loss in a day from my guess and what it sounded like he said. And so that kind of can negate multiple years of gains if you're not aware of how this works. Now, I think he's actually significantly recovered, so this is not like a promotion of him, but I do think he's doing the right thing in terms of staying consistent, still doing the trades, but you just need to be very aware of your margin and your volatility exposure. So if we zoom in here, this spike more recently, just a week ago, basically the market went from 15 VIX all the way to 30 almost in a day, almost 30 in a day. So this is not common, but I think it's going to be more common in the future. So people need to be aware of this. You need to always look at what is your Vega exposure. So let's go back and look at this scenario in general. Let's go back to ES. pull this back up and kind of walk through this scenario right here. In a minute. Okay, so if our Vega is negative 207, what that means is with a 1% change, we either make or lose approximately $207. So imagine you had this position on, and the VIX spiked 15 points. So that would be basically 15%. So 15% times $207. So you basically instantaneously lost $3,100, basically $3,105, with the market going down a few percent, yes, but so you would have lost a little bit of money also on the direction, but mostly on the volatility spike. So you need to be aware of that can happen, and that's where you need to have your stop losses in place, because basically if you end up taking a $3,100 loss on one and you didn't limit it, you need significantly more trades to get back to even, and that's why it's critical to have something that's mechanical in place, in my opinion, long term. The other thing I'll mention is margin. So you can see that the initial margin is fine. It's good to know that, but you need to know how much it can change with the market dropping. So if the market dropped 10%, it would literally almost triple your required margin. So you might end up getting a margin call if that is happening. And that's why I would not exceed 50% of margin used in an account. I mean, you might do that if you're only allocating a certain amount to a strategy, but in general, I wouldn't recommend it. We have volatility-based kind of risk management. It'll adjust how much it will allow for an allocation on Options Autopilot based on the VIX level. VIX is currently at 18. That's slightly below average of 20. So you would actually be allocating less, and it actually would allocate more if VIX is higher. Again, we're betting on volatility mean reversion, but you just need to know that volatility can stay higher and the market can stay down. And the famous saying is the market can stay irrational longer than you can stay solvent. That is true. That's why you don't necessarily want to put everything into this type of strategy. You want to space it out across underlines and strategies in general. But right now we're just going to cover the 1-1-1. But I want people to fully understand this scenario here and what can happen in general if the market starts to move against you, because everyone talks about win rates and how much money you can make, but you just need to understand that that doesn't always happen. There's sequence of return risk, and I show this in the backtesting example of the 1-1-1 that we did on Tasty Trade. It doesn't fully reflect the ability to earn a multiple unless you use no profit target in general. That's another thing you need to know about backtesting. There's a limitation of data. And the other issue is that there are certain times when you could potentially have a few losses in a row. And so you need to stay consistent, and you also need to manage your profits and your losses correctly and the same, I would say, either way. So I basically laid this out in a little bit of a spreadsheet to highlight it. I did this on the systematic put spread and the 1-1-2. So if you want to check those videos out, they're also on the channel, and I walk through those and how to automate them. But in this instance, we're seeing that we can have a profit potential of $760 and on the initial margin of $47.79. In general, what you also want to be aware of this is the potential if you let it go to 100% of the credits. It's hard to know exactly how many times it's going to finish in that bear trap. I could actually figure it out, and maybe that would be a helpful other video to do. But I would only probably always assume that you're going to earn the credit versus your loss, and you want to manage your loss based on that. So typically you're going to go for, let's say, a 75% profit target. If you're doing that, you need to also adjust your stop loss because you're not getting that actual full credit. A lot of people say, oh yeah, it's $760 potential. You're almost never going to get that fully, and you probably want to manage it a little bit earlier. There's a potential to have this convert to a hedge on Options Autopilot, but in general, we're just going to say, okay, if we hit 75%, we're going to take our profit, and if we hit our loss of 1330, then we're going to take our profit. In general, I'm trying to usually do a ratio of 2 to 1 This is, or 2.5 to 1, just so it can technically recover in only two and a half trades if it took a loss. This also helps limit it if you have a string of losses. Now, here's how I'm kind of approaching it here. So why am I choosing a 92% probability of profit for this? And the reason I'm doing that is it's based on the naked put I am selecting for our position. So if we scroll down here, where we add the simulated trades, what I did to select the 111 is I basically go out. In this instance, I'm choosing 110 days. This is a longer term kind of 111. I think it's a better use, and you actually usually have less required margin, so your capital efficiency is better. But the way I like to do it, some people will go even farther down. I like a little bit more gamma in my favor. So just a general rule of thumb is that gamma is highest around the 30 delta strike. So basically what I did here is I chose the 29 delta. I'm long the 29. I usually like to have about a 5 delta difference. I sold the 24 delta, and then I go and I sell the 8 delta. So this is where it comes in, that the 92% probability of profit. You can roughly say that the delta is the percent chance of finishing in the money, so it should have the inverse percent chance of finishing out of the money. So that's why 92%, obviously 100% minus 8, that's 92. You also need to be aware that the probability of touching is usually double the amount of the delta. So there's technically about a 16% chance that the market might touch this strike. If that actually is happening, you probably would have already had your stop loss trigger. But if it's close to expiration, that's when you could make some money. But if you're all the way down at this strike, it's probably closing the trade in general, and that's probably the best case scenario that you would want that to happen, in terms of you want it to close out instead. But those are the strikes that I'm choosing. That's how I built this. Also be aware of your assumptions here on your bid-ask spread. Typically you want to choose the midpoint to get it to be accurate to real world kind of scenarios. And what Options Autopilot would do would target the midpoint. It tries to get you a little bit better fill, and then it'll move towards the mid and a little bit worse than the mid to finally get a fill. That's what you would do normally, so that's how we kind of programmed it. But you want to be careful on how you do these, because it can change your profit potential and your loss potential based on what you use for these inputs. So that's what we chose. That's why I chose it. You can see, let me unlock this. One of the benefits of this trade is obviously you have a lot of room to the downside. But that's also because you have a lot of room to expiration. But you can see the market falls 10% in basically a 3.5 month period. You're right in the middle of your bear trap here, and you have approximately probably a 15% drop, and you're still technically able to make multiple on your credit. So this is one of the benefits why I think the 111 is so flexible. A lot of people talk about the 112. You just are that much more short vega, so things can go against you more quickly. Again, we have some logic and parameters that you can select on Options Autopilot to actually make it better or turn into a 111. So it's like you have the potential to get the extra credit, but then it'll manage it to basically turn into a 111. So it's kind of a little best of both worlds, ideally. But if you just wanted this to be very simple, you're just like, hey, I'm just trading the 111. I think that the ideal scenario is just to do this. It's, you have less to think about, less to look at, but you do want to monitor it in general to look at that. So if you didn't want to do that, that's why, and I actually think it's more beneficial to not watch the market and just let it mechanically play out. That's how you make money over time. But that is going back to what we kind of laid out here. What's the potential? And I would always look at it over 100 trades. You don't want to look at it over 10 trades. Like I said, you can have streaks of losses and streaks of wins. You probably want to look at it over a 100 trade basis. And that would be, if you're doing this on a weekly basis and putting them on, kind of staggering them, that would be approximately 2 years. So the profit potential, and what we did here, as you can see, is we kind of took the average profit target and then the probability of that profit, and then times 100 trades to get that number. And then same thing with the losses, right? We did the, oh, I need to change that. So that actually helps us. Okay, so that's beneficial. Good thing I caught that. And you can see this is live, not making it up. So across 100 trades, this is kind of saying how often you would lose and how many losses you would take. Again, this is just an example. There's no guarantee of this, but this is how you want to think about these things, right? That's the whole concept, is just thinking about it and how to approach it, not necessarily being exact on this, just having the mindset to be like, okay, I need a positive expected value on my trades in general. We can see this is a pretty high positive expected value in general on this strategy. Over a couple of years, that would be actually pretty huge, right? Making about $20,000 a year extra, so that would be helpful. And then what I also was assuming is that you would put 8 of these on at any given time, and you would kind of limit your trades to 8. And so based on the margin required, this is the minimum projected if you were almost going to use all of your capital, right? I don't recommend this at all. Don't do this. What I would recommend is if you use a max margin of 50%, this is how much you would need. Again, though, if you had a $76,000 account and you could make $20,000 a year on that, I mean, that's a pretty sick return, especially if it's on autopilot and you don't really have to do anything. You don't even have to touch it or watch the market. You still want to be aware, but that's just kind of the beauty of automation. And that is what I've seen in our experience of letting options autopilot run. It's cool to just see the trades go off, and it just takes the profits or takes the losses and just continues doing it based on what you tell it, right? So I wanted to give you these metrics too. So return on margin, a lot of people and a lot of the back testing stuff that I've seen, just as in general, don't calculate this, which I think is a little bit misleading, because ultimately you're only tying up the margin, right? You're not tying up your whole account. So you want to kind of calculate a return based on this. That's the benefit of leverage. That's also the downside and why it can hurt you if things go against you. And what I did is tried to equate this to a rough monthly return, right? 3.3% on a monthly basis seems pretty crazy, right? You're almost touching, I can't remember if it was after fees. I'll have to double check this. I'm going to do a different video on Jim Simons and Renaissance Technology. Can't remember if they were 60% returns net of fees, or if it was around 30% net of fees. But either way, if you're able to earn a 3.3% return a month, that's an insane return. You'd be beating almost all the best money managers on the planet. Again, it's because of the margin. That's where you have to be very careful and follow your stop loss and your profit targets very strictly. That's where I think it's helpful to just have it be mechanical, because I myself, even as a CFA and having traded for years, we're just wired to not respond correctly to these scenarios, which is one of the reasons that I built this software. So this gives you the breakdown. This is how I would look at it. You could plug in your own if you wanted to do it manually, but this is kind of what you would want to go through and know, where are you taking your loss, where are you taking your profit, and make sure you stick with that, and then just do it on a consistent basis. The other thing I would say is if people just wanted to do this more simply, and I would recommend doing it every couple weeks. You'd obviously earn lower return, but less to do, and also it gives time if the market kind of gets a little volatile to kind of pull back. We do have a crash indicator on Options Autopilot that can then manage your positions for you if you wanted it to adjust. But in general, to make it easier, you could just say, hey, I just want to trade every couple weeks, and it should help kind of smooth out that ride if that did happen. So let's kind of dive in actually to how would you automate this trade. Let's go over to Options Autopilot and check it out. This is just our test account. It's actual money. What you would do, I already have it set up, but All you'd have to do, obviously, you connect your account, sign up, and then connect your trading account, Tasty Trade, Schwab. We are close to having TradeStation. I'm sure by the time I put this up, we'll have TradeStation and Tradier set up as well. You just go to Create Automation. You can go to our strategy kind of template database and choose an applicable strategy. In this instance, we're doing the 111, choosing the 111 template. You would choose your underlying brokerage and choose your applicable account. Obviously, you can connect to a new one. I did, the ES on this one. Right now, we have MES, which is the micro futures option, SPY that requires more margin, or SPX, which is the big boys. That's the most capital required, but obviously that's going to be the most liquid. But we are going to expand this significantly. We already have the ability to do, oil, gold, bond, futures, all of those, and those will all be live as of probably everybody watching this video. So right now, though, we're doing ES, and you can choose, like I said, I would do 100 days. If you really wanted to, it was 110, and what the system does is it does 105 days or more. So it'll choose the next closest day's expiration, and then do your allocation. Right, you saw that it required about $4,800. That's based on current market environment. Again, if you had a large enough account and you wanted to allocate $25,000 of this, then you could. But if you only wanted to have one out at a time, you would need a minimum of 5,000. I would maybe recommend doing a little bit more than that in general. Here's where you'd set max open positions. Like I said, I would choose 8 if you only wanted to have 2 months on at once. So to be doing it every week, it would stop when it hit 8. Most likely you would have one that's taking profit or taking a loss at any given time. So it would be continuously opening and closing new trades. But you can choose this. You can keep it limited to 1. The system will stop when it hits a allocation, and it also will check to see if a trade, like a new trade, putting a new trade on would put it over the allocation. So for example, if you basically chose 8,500, I'm just doing that off the top of my head, and it put one trade on and that took 4,800, obviously the next one would be at, what was that, $9,600. It would not allow a second trade to happen because your allocation is at 8,500, and you'd get a notification for that. But right now you can see the settings are how I would have set it up, with a target delta of 30% or 30 and 25, and then 8, and that will just put it on automatically. And here's where you'd set your frequency. You basically set on a weekly basis. I want to do it on Tuesdays. You can choose whatever. I don't think that there's any study that's shown that it's a better day of the week to put on a 111. I think it's just being consistent is the key to doing this and doing it well. If you wanted to do it like once a month, you could. If you want to do once a month, you could do that. You would just choose what day of the month. It could be the first day, depending on when you're doing this. Like, obviously, I'm filming this on December 28th. If I wanted to do 1 month from now, I could just do, the 29th. Or if it's already happened, 28th, right? So what I would say for beginners, you could just do twice a month, first of the month and 15th. However you want to stagger this, you can. But otherwise, if you're choosing weekly, you could just do 1 day a week or multiple days a week, depending on how you want to do it. Here's where you set your profit target. I think we did 75, and you can change it. You can keep it the same. Here's what you could say if you wanted to convert into a put spread hedge. What that means is if you hit profit target on your short put, it will close the short put down, like the very far out of the money, the 8 delta one. It'll close that, keep the put spread on. So you basically have a low cost kind of put spread hedge. It's not a full hedge, of course, because it's just a put spread, and at that point it's pretty far out of the money, but it can help you a little bit on a drawdown or a volatility spike like we saw. So you can do that. I'm leaving it off at the moment, but here's the time stop, 15 days expiration. Just better to manage that. Gamma can get a little extreme if you let it go under 15 days. So at that point, it should have already hit your profit or loss. And if not, it just ends up closing the trade. So you can just open up another one. So you just hit create, and then you'd be set up, and obviously you can see we've already got a bunch set up, and I had a bunch running. This is not correct profit and loss. It's actually about $3,700. We had to reset our database multiple times as we were getting this all set up, so it doesn't fully reflect the whole year in general. But that was also on 7 to 10,000 at most of margins, so pretty high rate of return. So that's cool. Not that we haven't taken some losses, but in general, just in the past, I guess we kind of started this in May. In the past 6 months, basically earning a decent percentage there. And reflective of that, we've taken less risk, so it's probably been around 2% a month, 2 to 3. So again, no guarantee that will be the case in general, but that's kind of what you could maybe expect to earn with these types of strategies. So that's how you would automate it. I also have put below the PDF version of this strategy, as well as our other top 2 strategies that are popular, actually top 4. So we've got the 0 DTE, which I also covered in another video. We got the put spread, we got the 1-on-1 and the 1-1-2. So if you're wanting to see our approach, if you're going to do that manually, feel free to download that. And if you want to automate it, obviously sign up for Options Autopilot, check that out. You can test it out, do a paper trade, however you want to approach that. That I think is a super good tool. Honestly, I created this for myself personally originally, and then someone's like, well, you should let other people use it. And this has been the issue in my trading over the years, just working and not being able to watch the market, but knowing what I should do when. And so now you can kind of put that in place and just let it run, and hopefully you should be able to collect the premium, the risk premium from the options over time, and collect the kind of theta decay. So hope you enjoyed that. If you did, thumbs up, like, subscribe, all the good stuff. Hopefully share that with somebody that could benefit from this. But yeah, thanks for watching, and check out another video trying to do this type of in-depth analysis to help everyone that's trading options and trying to avoid the pitfalls that I did going through my basically 15 or 20 years of trading. Yeah, I guess 04 I started trading, but didn't start really trading options till 07 time frame. So anyways, thanks, and I'll talk to you guys later.